Let's talk about how to legally reduce your taxes, or ideally, how to pay less of them. If you're new here and want to learn how to increase your income, subscribe and hit the bell so you never miss a video. Make sure you watch until the very end, where I'll share what I believe is one of the best ways to reduce taxes. One way to pay fewer taxes is to make less money, but that's obviously not the goal. A more effective strategy is to make your itemized deductions equal to your income. In the 2022 tax year, the standard deduction is $12,950 for single filers and those married filing separately, and $25,900 for those filing jointly. So if you earn no more than $12,950 as an individual or $25,900 as a couple, you typically won't owe any federal taxes. But here's the issue. Living on that little isn't very realistic. It's technically possible, but the quality of life would be pretty limited. We don't just want to survive, we want to thrive. That's why focusing on itemized deductions makes more sense. These include mortgage interest, property taxes, and charitable donations. To deduct mortgage interest and property taxes, you need to actually own a home. So owning a primary residence can be helpful because the government allows you to write off those costs. If you want to go further, you can get into real estate investing. Buying a rental property gives you access to deductions like depreciation and operating expenses, which help reduce your taxable income. This is one way to be more tax efficient when earning money. Donating to charity is also a great way to cut your tax bill while supporting causes you care about. Rather than sending that money to the government, let's look at some examples. First, how can you pay less on income taxes? Say your job pays you $90,000 and you earn another $10,000 in dividends. That's $100,000 in total income. Now, let's say your deductions include $30,000 in mortgage interest, $20,000 in property and state taxes, $12,000 in charitable donations, and $18,000 in 401k contributions. That's $80,000 in deductions, which brings your taxable income down to $20,000. You'll still have to pay property taxes to your state, but at least those are deductible, meaning less goes to the federal government. Now let's look at rental income. Suppose you bring in $50,000 a year from your rental property. Your deductions could include $15,000 in mortgage interest, $5,000 in HOA fees, $1,000 for maintenance, $8,000 in property taxes, and $23,000 in depreciation. That totals $52,000 in deductions, more than the income. So your taxable income from the rental would be zero. Owning rental property is like owning a small business. Most of your property-related expenses can be deducted. Depreciation is a key benefit. It's a paper loss that lowers your taxable income without costing you actual cash. Property taxes are unavoidable, but they're deductible too. To reduce those, you'll want the city to value your property as low as possible. The lower the assessed value, the less tax you'll owe. Keep in mind that rental real estate isn't 100% passive. You still need to manage tenants, handle maintenance, and deal with occasional headaches. As you get older, managing properties might not be as appealing, but the tax benefits can be worth the extra work. Let's say you run a small business, like a bakery, and make $100,000 in revenue. Your cost of ingredients is $10,000, leaving you with $90,000 in net revenue. Then you subtract $25,000 in business expenses like marketing, travel, meals, and admin costs. That leaves $65,000. Now add in retirement contributions, $31,000 to a solo 401k, and $10,000 to traditional IRAs for two people. Your taxable income is now just $24,000. You can also deduct things like mortgage or student loan interest, HSA contributions, or startup costs. This is why having your own business gives you more flexibility. Many personal expenses like travel, meals, even a home office, can be business write-offs if used properly. And if you're both the employer and employee, you can contribute even more to your retirement accounts. For example, in this case, $31,000 was saved from being taxed. You can also reduce your tax burden by paying your kids through your business. If you're in a high tax bracket, this shifts income from your rate to theirs. If their income stays under the standard deduction, they owe nothing in taxes. You can even open a Roth IRA for them. The contributions grow tax-free, and can be withdrawn tax-free after 5 years. And the final tip, start your own business. Starting a small business is one of the best ways to lower your tax bill. You get more control, more deductions, and more opportunities to build wealth. Even something simple, like creating a website or doing freelance work, can qualify. Build it up over time and pay taxes only on your actual profit. Thanks for watching Investing Flicks. If you found this video helpful, don't forget to like, share, and drop a comment below. For more expert insights on personal finance, investing, and wealth building, hit that subscribe button and turn on notifications so you never miss out.